very relevant for Australia's economy. Australia is the largest supplier of iron ore, and this is what this chart is showing you. So the blue on the left-hand side, the blue bar shows you the crude ore body. So it's basically dirt or mine ore that is underground at the moment in Australia, right at the top. There's about 50 billion metric tons. Of that, the iron ore, the metal component, Fe component, which is what's used to go into steel manufacturing or production. That's about 24 billion tons of iron ore content. That's sitting in works out to about 65% on a practical basis. But yeah, so that is the iron content that Australia's got in reserves that it converts to production every year. Around about 900 million tons of iron produced and exported to make, and I'll show you where that is exported to next year's slide. But and Australia is the largest producer. And so if you look at 24 billion, iron ore content that Australia's got in reserves, and is producing about 900 million of that. This is roughly about 25 years worth of resource available through the likes of BHP, Fortescue Mining, and Rio Tinto. These are the major miners of iron ore out of Australia that have got into the mine life. The next cab off the rank in terms of exporting country or supplying country is Brazil, but it's got 15 billion metric tons of iron ore. So it's much behind Australia, and then the others like Russia, and it really just tails off from there. So Australia's got 50% of the world's iron ore export market share. The next cab off the rank is 23% is Brazil. And so that's very important to understand. Hopefully I've portrayed that picture here in terms of which countries are supplying. Yeah. In terms of annual production, what this chart on the left is showing you, what the iron ore reserves look like. What the production levels are on an annual basis. In Brazil, Australia produces 900 million metric tons. Brazil produces less than half of that on an annual basis. But if you look at the left-hand chart, the bar that is, just compare the two bars for each country in terms of the time period. So 2010 is represented by the blue bar, and the maroon one is the most current year's production reported for 2020. Now, if you can see Australia, it was producing, 450, just over 400 million metric tons back in 2010. In the last 12 years, it's bumped up to obviously 900. Now, if you look at Brazil, there was a bit of a bump up from 12 years ago, but it hasn't been that much. If you look at Brazil's production of iron ore since 2015, the black bar, to 2020, is being more, for all intents and purposes, it's been flat. So now, whilst the demand is growing globally for iron ore because this demand for steel production is growing, the excess demand has been supplied basically out of Australia. If you look at China, it's fallen off the cliff, its supply. So in 2010, it was supplying over 1 billion metric tons. It's now down to just over 300, and it's falling. And I'll explain to you why that is the case. And all the other countries are just tails, so they haven't got scale operations. And this is very important. So Australia supply, what I want you to take away from this and the previous slide is Australia is basically the supplier of iron ore internationally. It is well positioned. It's secure and a reliable supplier of global demand for iron ore. And if demand for iron ore goes up, it comes out of Australia. It has shown the ability to convert its reserves to production. Brazil, not so much. Next slide, please. this is why this shows you the importance of having a large iron ore content or Fe content in an ore body. So imagine you've dug out a bit of dirt out of the ground, and it's got very minute small levels of metals in it. It's very hard to filter that metal out because it takes a lot of processing. The higher the percentage of metal content in an ore body, the most economical it's going to be in terms of production and processing and cost of production. So if you look at South Africa, Canada, and Australia, they're right up there in terms of the ore body that they're digging out of the ground, the likes of BHP and Rio and Fortescue's. Fortescue a bit less. Their iron content is very high. Their cost of production is very low. But if you look at, I mean, China is not even there on that. So it's very costly for China because their content is not much there of that metal. So it's very costly for it to process iron ore when they dig it out of the ground. So therefore they're not economical. Therefore they've just continued to just decline their share in production. This is important. Again, it points to the importance of South Africa and Canada. Yes, their iron ore content is very high, but they haven't got big reserves. So they're not scale producers as a result. Australia is a scale producer. It's got massive reserve, and it's got good quality of reserve, which is economic to produce. It's important to understand that in terms of supply side. Yep. So let's talk about, so we've talked about the supply is basically an Australian story with some support provided by the Brazilians. Let's talk about demand. On the left-hand side, you can see demand is all about China. So global iron ore imports, 75% or 3/4 are basically imported by China. The next country is Japan, and really no other country or even a region compares anywhere near the appetite for iron ore imports that China has. Now, China is using these imports to obviously convert into steel. Basically, 95% of this iron is used to make steel manufacturing for applications like construction materials, vehicles, and machinery. Now, this is not entirely steel produced for obviously internal purposes as much as exports as well. So that sort of sets the picture for demand and supply of iron ore. Yep. Okay, now let's explore why this iron ore price rout has happened, and let's do the analysis on what the implications are with that backdrop of supply and demand. Okay, so as you know, so it's an iron ore is basically a steel production story. So you've got to pay attention to how much steel is being produced by the Chinese steel producers, and sort of try to understand that picture. So let's start with, so the steel production out of China has been a story of two halves. So from January to June, it's been, as you can see, the 2021 production numbers shown by the orange bar there have been way above the previous year's production numbers. So they were just still producing steel left, right, and center. What that did was they obviously bought a lot of iron ore off the producers like BHP and Fortescue and Brazilians, and stockpiled as well, and that really had the supply side trying to catch up, and and was basically behind the demand by a country mile. So what that did was that made the iron ore share price, the price of iron ore, as you can see on the right hand side, the chart there, just bump up to the historic highs of $220 or $30 a ton right into the last month of June of this year. But what happened after that? and so as that was happening, the iron ore price tried to interpolate, thinking that these real stepped up numbers in the first half or the months of Jan, Feb, March are going to continue on for the rest of the year. So the iron ore producers, the market was basically pricing the iron ore, thinking that these stepped up production numbers will go all the way out to the year, and that's what the new forecast is going to show. But then the Chinese government came out and said, "Now, hang on. What we want to do is we want to plan the production of steel around Beijing Olympics, Winter Olympics in February of next year, 2020-22. So what we want to do is we want to have, on a nominal basis, flat overall production from Jan to December in 2021 compared to the last year's numbers of 2020. So they said, look, we want the steel producers, and China is obviously a planned economy. They've told their steel producers, together, all of you guys are not going to produce more than a billion and 50 or 60 million metric tons for 2020, flat in line with last year. So we're gonna, and what the reason why we want you to do that is produce as much as you can in the first half of the year and start to ramp down your production, because we want clean air heading into the Winter Olympics. Now, what that ties in with is with obviously China preparing for the Olympics, and it wants to showcase the best kind of air quality that it can achieve leading into the months of February. There's going to be tourist intakes into the country, and China's got obviously its carbon emission. It wants forecasts as part of its next decades of planning. By 2060, it wants to be carbon neutral. So it wants to be seen, and it's also come out in the market and said, look, our annual production capacity of steel by order of 20 to 25% in the next 3 to 4 years, we're going to use renewable energy sources to produce that steel. Now, that may be renewable energy, or they might, as part of the broader Belt Road program, they might take off those manufacturing installations and put those steel manufacturing installations in other countries with not similar quotas on carbon emissions and achieve the target that way as well. So net, China's production is not going to decline. It's just going to have a different mix. So that's very important to understand why these numbers have declined in steel production. And that obviously has, as the production numbers were running high above the previous year for the first half, the iron ore price interpolated well ahead of the demand. And now on the downside, as the Chinese are cutting back on the production numbers to meet the overall flat number for the year, the iron price is sold off. We've done the numbers, and so far this year, from January to August, China has produced 730 million metric tons of steel, and it needs to produce, to meet its flat objective for production for this year, it's got to produce between the months of September and December, it's got to produce about 324 million metric tons. So if you divide that by the 4 months remaining, that's about 81 million metric tons. So we're per month. So we're estimating the August number of 83 million metric ton that came out, reported by Chinese, and the market's being jostled and thinking, oh shit, how much is going to sort of continue declining? If you put that into the context of the overall objective for the full year of production, September, October, November, December should be somewhere around 81 million metric tons, and that's where the production of steel should stabilize, and as a result, the iron ore price should stabilize at current 100 level mark, or in the 90s dollars per ton mark. So that's the analysis behind the route and where we see it going forward in terms of stability. So as I mentioned, Beijing Winter Olympics is one of the driving forces here, and the steel sector, just what I didn't mention previously, was it's an emitter. It's a significant emitter of carbon dioxide in the order of 15 to 20% emissions. So that's why it's an important factor for the Chinese government to control. Yeah. So as I mentioned, with production cuts in steel, we expect another month of step down. In September, numbers should be 81 million metric tons, as I mentioned, and that should flatline into next year. Now, you will probably get another few soft numbers in the first few months of next year, 2022. Obviously, Olympics is going to be in February, so January, February might still be soft numbers for production of steel, but then we might get a ramp up in the subsequent months in 2022. Now, obviously, as I mentioned, so that should put a lid on where the iron ore price is going to be over the next few months, 6 months to 9 months. We think it's in a benign environment with support coming from production numbers, as I've mentioned. But the downside, if there's further downside to the iron ore price, it will probably come from. So we've got some certainty around demand from China, but there might be some excess irrational supply put onto the seaborne market by the likes of the the producers, basically. But they're fairly rational in their behavior as well. So if they can see demand building up in the back half of next year, then I would see them probably stockpile their production volumes here and now in Australia and then sort of feed it into the market. So we should see rational behavior. So, but if that rational behavior is not there, then there would probably be further downside to the iron ore price. Yep. So that was obviously Beijing Winter Olympics is one of the reasons controlling emissions there. The other reason is, President Xi in China has got a social agenda through his new 5-year, 10-year policy of achieving common prosperity, greater equality, and social stability. And we're seeing that amongst, in a number of different sectors, how that's playing out in terms of application of that overall policy. And so what the Chinese government don't want to see is, obviously they planned their production of steel this year through the two halves, as I explained, and that led to the cost of steel on an average go up by 15-20%. Now, someone's got to pay for that higher cost of steel through obviously machines that are being produced, different bits and products that are being produced, and the construction materials that are being put into the ground for residential construction or social construction, whatever it is, and the buyer has to pay the price for it. So what we're being, it's not in the interest of the government. On the other hand, they've got to maintain inflation as well. So what we saw with obviously that demand management was the production cost of steel went up by 15-20%, and then that saw the producer prices in China go up by 9% as well. So that is not something that China wants to see. So you're seeing that play out as well, and you might see the reversion of more steel being produced in 2022, just to sort of back out that tightness of supply as well. But China is also trying to manage prices through the likes of property developers, through what we've been hearing, by saying, look, there's putting caps on how much they can charge in terms of in the contracts for property and that type of thing. So the BHP, I mean, what's the implication for the 2 or 3 largest producers of iron ore in Australia? BHP obviously is the biggest one. It sold its energy assets recently to WPL or Woodside Petroleum. So BHP is pretty much the iron ore and copper story. And iron ore at price at $100 a ton. As I mentioned earlier, producers here are quite efficient in their production. So they're producing iron ore at $18 a ton. Forward estimates for 2022 production. So there's a good margin there for these guys to remain fairly obviously profitable. And the longer term China growth and urbanization infrastructure development continues to be the thematic. On the valuation side, you can see that BHP, in terms of forward EBITDA valuation, you could say it's attractive. We're not going into the stock, adding to the stock at the moment. We would like to see more stability in the iron ore price and just get some more comfort in stability in the the steel production numbers. But from a valuation perspective, BHP is looking very good, and the dividend yield is obviously very good as well, because they've been harvesting a lot of capital and cash flows and paying back to the shareholders as well through dividends. So that provides good support to that stock. Rio Tinto is another one, major iron ore producer, copper as well. It's got obviously near-term soft outlook on the back of the reversion in the prices there, but it has entered the lithium market as well, off the back of the lithium battery storage play going into EV vehicles. So that is a bit of a alpha for that stock potentially in the future in terms of diversifying the resource base. But if you look at what BHP has been doing in recent months, they've sold off their gas assets, energy assets. They've been simplifying their listing structure. I wouldn't put it, and if the iron ore price remains soft, I wouldn't put it past a BHP and Rio Tinto potentially doing a merger, because they're starting to look very similar in terms of their profile of their production, in terms of what they're producing, metals. So it might make sense to get efficiencies by running those portfolio of assets through a merger through one corporate entity as opposed to two. So I wouldn't put it past that being happening. It's certainly been looked at 12, 15 years ago, so that might be in the play, but we shall see. So that's what I wanted to just cover off and give you a flavor of in terms of what's happening in the iron ore market. And yeah. So I'll pass it on to Chai or Zach to take on.
Thanks, Zach. I'll just do my little bit before Zach talks about specific stock recommendations. And a lot of my actual talk relates to what you and your presentation. So what I'm discussing today is whether AUKUS will be awkward for the Australian equity markets. Now, firstly, what is AUKUS? AUKUS is essentially a trilateral security partnership between Australia, the UK, and the US that was announced by the three leaders last week. It came as a surprise because part of that initiative really involves, at its first instance, the development of nuclear submarines. Now, in his statement dated last week, the Prime Minister said that, sorry, give me a sec. Sorry, I had a bit of a computer glitch. In his media statement last week, he said, "We will foster deeper integration of security and defense-related science, technology, industrial bases, and supply chains." As the first initiative under AUKUS, recognizing our common tradition as maritime democracies, we commit to a shared ambition to support Australia in acquiring nuclear-powered submarines. Now, that's very interesting because Australia, back in 2016, the then Prime Minister, Malcolm Turnbull, signed a $90 billion contract with the French government to develop French conventional submarines in favor of nuclear power submarines. Now, obviously, since the announcement, France and China have condemned the initiative. This is really an interesting time for us in conducting, equity fundamental analysis and valuation and managing portfolios. As investment managers, my role is not to make any political statements whatsoever, and that's not my intention here. What I'm more concerned about is how to decipher the state of politics with the purpose of managing these portfolios, with the purpose of understanding what the current and future impact that this agreement has on the Australian economy, and essentially what it has by way of financial impact on Australian corporate earnings. It's really difficult at the moment with this because there's a lot of geopolitical tensions between Australia and France, and Australia and our largest trading partner, which is China. As you can dissect from Max's presentation, with a focus on the iron ore sector. So we note it remains unclear how much this deal will cost the Australian budget, and how much Australia will need to pay France by way of compensation to end the prior contract. The second point is that the French have already withdrawn ambassadors to both Australia and the US, and so the interesting part is that, you know, what we're worried about is a further escalation of that by way of how it would impact trade relations between Australia and the French, but more so what it means for trade relations between Australia and China, especially the free trade agreement that we have in place. This rhetoric and this escalation is not good for business. One of the things that we have done in the past week is essentially highlight companies where we really need to talk closely with the management team. We produced a report that is available upon request, with showing a list of companies where we're currently talking with the management teams and asking, hey, what is the impact? To date, the responses have been a big question mark. They simply do not know where the earnings impact will be here on in. But suffice it to say, if past examples by way of increased trade tariffs and banning our products is any indication, then this issue, this AUKUS issue, will be a really awkward time between Australia and China. Through the list, the report that we produced has a list of roughly 40 to 50 businesses where we're focused on analyzing at the moment and talking with the management team. The list here that I've put in front of you in my presentation highlights just a few. So we're quite worried about, obviously, Australian exporters. We're worried about agriculture. And as per Max's presentation, we are the largest iron ore exporters to China. So we're certainly worried about the resource companies and the unquantifiable nature of what it means for earnings at the moment. The issue would be a drag for Australian equity markets, in our view. Some Australian exporters are A2 Milk, which exports formula milk baby formula milk to China. We've got Australian Agricultural Company, AAC, which exports beef and Wagyu to China. More so, they've been trying to divert that because of the increased tension between in the political realm between China and Australia that has transcended to the financial and the trade relations realm. We have Bega Cheese that we're currently analyzing that does a lot of business in China. Obviously, BHP there, as per Max's presentation. We've got Blackmores that exports a lot of vitamins to China. We've got another infant formula milk business in Bubs. Then we've got farms that CGC operates. We've got Fortescue, Rio Tinto, and Treasury of the United States, which already has seen the backlash by way of higher excise taxes being implemented by the Chinese. So without a doubt, we can't quantify what the earnings impact is at the moment. especially as the situation evolves. And so at the same time, it is in the back of our minds. That's essentially what I'm trying to highlight. And that pretty much is my presentation. I'll pass it over to Zach to talk about stock recommendations.
Yeah, good afternoon, everybody. Thanks, chat. Thanks, Chai. Thanks, Max. Two very important topics the guys just discussed. So I think really it's well worth hitting some attention towards that way. So some interesting names that we wanted to present to you. First up, Ansell. So Ansell, we put it up, we upgraded to a buy. We've known this company for a very long time. It's good quality business. It has divested businesses in the past. It's become a little bit much cleaner. Obviously, Ansell was a big beneficiary of all the hygiene-related activity that went on with COVID-related. And obviously, I think some of that is going to be fixed and structural, as in, I think, there's always going to be an element around of personal business consumer hygiene, and so that's going to stay. But nonetheless, the key insight really here is, and which is why the share price has dropped, is the market is worried about moderating earnings over the next 2 to 3 years. That is absolutely valid, and we have fully accounted for that in our forward estimates, in our 5-year future EBIT CAGR. And we believe our forward estimates is actually a bit on the conservative side. So we get markets concerned. We've accounted for it in our numbers, and then the valuation around DCF is still coming out attractive from our perspective. The other point really is that Ansell is currently trading on a forward PE, which is largely in line and perhaps a little bit lower than its long-term historical average. So put all those together, we think this has still got good solid business, and the valuation is looking undemanding. We've accounted for near-term moderation in earnings growth, and when you put all that together, we get a pretty decent price target of $40.50, and that represents a half decent upside to our current valuation. Hence, we've got to buy. So this is a good, we'll move to the next slide, Chai. But this is a good quality business, and we think the recent weakness in the share price probably represents a good buying opportunity, hence why we've upgraded the stock to a buy. This is an interesting one. So Vicinity Centres, as you know, is your traditional retail REIT, but what kind of really caught our attention in the recent results, and it's not so much, this is new, but look, I think if you're a REIT, and you're exposed to those old economy, traditional retailers, business and whatnot, you're looking to transform. Centre Group is doing a very good job from going to, just shops in their centres, highly dense, where they're Westwoods and highly dense centres. They've got access to foot traffic. It's just that they need to keep up with the trend, the consumer, what the consumer trends are saying. And so they've gravitated more towards experiences, restaurants and whatnot, specialty retailers. Because specialty retailers, you still need to go in and get it because it's very specific needs. So Vicinity Centres for us is interesting in the fact that they're on a similar journey. And mind you, I'll put the caveat that they have been on this journey for a couple of years. It's not a slow ship to turn around, but we like the fact that they're looking to remodel their REITs to more forward-thinking real estate business. It's trading at a really deep discount to the broader industry, and I think there's an opportunity there. It trades at a 12% odd discount traditionally in historical, but it was when we put it on a buy, or when we maintained it on a buy, it was trading at a 23% discount. So, and the other point I'd say about this as well, Charles, we can go to the next slide. The other thing I'll say about Vicinity Centres is that it's a good reopen trade. And if you look at a research note that we put out, when the restrictions were lifted, the demand came back and the income was coming back. So Vicinity Centres is a good reopen trade as well. Goodman Group, I think this is a good quality business. I don't want to talk about the structural drivers behind it, but what I want to just suggest that within the large cap sector, the ASX 200, so ASX 100, a company of this quality giving you 10% year-on-year growth, earnings growth, a half decent yield, and that has no real structural issues to its business models. In fact, it's leveraging off the tailwinds behind it. We think this is a really good company. And when we, rejigged our numbers and rejigged our valuation, it was coming up with enough upside for us to put this on the buy. And for us, a quality business of this nature, especially in a broader sort of a portfolio construction point of perspective as well. If you can pick up a good company with, Charlie, we can move to the next slide. If we can pick up a good company where earnings are more stable in this environment, as you see, as guys talk about, where we've got issues with iron ore, we've got issue with geopolitical issues. Those kind of companies are hard to find. So that's one with that we upgraded to a buy. The other company we like is Suncorp. We upgraded to a buy. This is a good quality company. It's got the share buyback going. It's got trading at a good yield and PE. But there's something else that I think worth highlighting about Suncorp. So Suncorp has a banking business and insurance business. The banking business is actually pretty attractive, but there's something else about the banking business. The banking business takes up almost half of the company's capital at lower ROE. So the group ROE relative to, say, its peers, Suncorp to its peer like IGA, is much lower because that banking sector, which only contributes about, contributes about 35% of group earnings, is taking up much more capital, and it's diluting the ROE. Now, just something out there, the company may choose to do something with this, maybe offload it, divest it. But if they were to do that, you think about it, this could fetch, given what other multiples being paid by CBA for Bankwest and whatnot, this could fetch between $3 billion to $5 billion. $3 to $5 billion you get from the sale of this business, or is this what this business is worth? You get an ROE uplift similar to levels potentially to IAG, which is trading on a much higher price to book, forward price to book to Suncorp. So IAG is trading about 1.89 times, and Suncorp is only trading at, I think, 1.2 times. So there is this value disparity between Suncorp and its competitors that I think that could also play out. That could play out in the long term. But yeah, from a broader perspective, good quality company. We really like it. Sorry, Ty, move to the next slide, please. And Suncorp gives you a really good yield. So in the current environment, that's also very attractive. The other one that I'll highlight is Baby Bunting. We've been really positive on this stock for a long time. But look, let me just hit the key points here. What's the market worried about? Market's worried about the slowdown in the first 7 weeks of trading. We think that's largely impacted by the restrictions. Once that is, you can't defer baby purchases for forever. The other point is, and another investor raised it with us, excuse me, was look, Best and Less is coming up. They've got a pretty good baby range. There's other guys coming up through the ranks. The only thing I'll raise there is, in response to that, is that Baby Bunting's SKUs, so the products that are sold in Baby Bunting, are largely either private labels, so exclusive to Baby Bunting, but then also exclusive, the third-party guys are also exclusive to Baby Bunting. It's got a pretty big footprint, and it's growing. So the ability to get the same product's value that you can for Baby Bunting is not necessarily easy with an alternative option. The other point I'll raise is the ability to go into Baby Bunting, and this is something that we focused on when we first started talking to the company, was have you got enough people on the store ground? People come in, they have a lot of questions about, prams, babies, everything baby related, and sometimes that's a big help. So, and you'll know most retailers, when it comes to trying to improve earnings, they will cut, because the biggest cost is actually people. So they'll cut frontline workers. Maya did this, David did this. So instead of having two people in one particular part of the business, in one particular section, like shoes and David Jones, they'll only have one person who's doing the consumer answering a question, and then also processing the sale. I know it sounds like minute, but it makes a big difference, because there might be two other people that walk in who don't get the service levels and then walk out, whilst this other person is being treated for the sale. So having people on the ground with good product knowledge is a key competitive advantage. So we think Baby Bunting, with the store rollout, the opportunity in New Zealand is pretty interesting. And so just go to the next slide. And this has got a good growth opportunity attached to it as well. It's not a big yield earner, but baby bunting for us is good growth and prospects. Another good company that we really like is Bapcorp. Again, slightly different. It's in the consumer sector, discretionary sector, but we like this business because it's got market leading positions. The product knowledge that you need. So yeah, fine. Amazon can sell various, company parts and car parts and whatnot, but you need product knowledge. You often need to ask questions. How do I actually, even if you're a DIY person, how do I actually, fix it up, or how do I implement it, or whatever it is? So that part of that process is still pretty relevant for these guys, and you can't really substitute that completely. So that's one thing I'd point out. The other point thing I really would point out is that, people are traveling more internally, and people have, whether you believe it or not, maybe the use of public transport may take a bit of a backseat for people in the current environment. But overall, you saw this massive used car build up in the economy, and I think that bodes well, obviously, for their future earnings growth. So strong market position, good buoyant end markets with people traveling locally and holidaying locally, and a half decent valuation upside to our current valuation. So we like this business as well. So I'll stop there.
Rajmi, that by and large concludes our presentation for today. I just wanted to mention individual reports are available for everything that we discussed today, and we can make ourselves available to anyone that would like a further discussion or has further questions.
Sure, Chai. Thank you so much for this presentation, Max, Zach, and Chai. It was very insightful today, especially about the AUKUS that you
Record